things considered, whether we like it or not, the investment community can and does have an impact on the price of metals, and right now they're positioned pretty bullishly. Moving over to carbon, this is a slightly different chart than what we normally look at, and the difference is this. What I've got shown here in this chart is the US, we call it the HRC, so hot roll coil 5th month futures contract. Now, what does 5th month mean? Within futures land, and actually within this world, to put it very bluntly, the 5th month futures contract is literally 5 months into the future from whatever point in time you reside in. So as we sit here today in February, basically the 5th month futures contract sits out here in the month of July, and that is essentially where the market thinks steel prices are going to be in July. Now, why did I run the chart using a 5th month futures contract? There was a little bit of rationale here, and the rationale is that if we as Ryerson or a trading company or another consumer wanted to go out and import metal, there's some sort of extra lead time on getting that product into the United States from either Europe, Turkey, Russia, Korea. On average, I would say that lead time tends to be somewhere in the realm of, let's call it 4 to 6 months. So that's basically the lead time to get it on a boat, insured, to our ports, and then into our facility for processing. The reason why I think looking at a 5th month futures contract is interesting is this basically represents that lead time. So this chart that you're seeing here in the white kind of represents what the market views as the domestic competitive price against import. And what I find interesting is what the chart is basically saying is there's really going to be no economic incentive to go out and buy a foreign product, particularly from Europe, because what this is showing is the European price in blue and the Chinese price in orange. And back here, when you see these big gaps between futures prices and where the current European market is, when those gaps get really big, you start importing a lot of metal because the market is incentivizing you to do so. Fast forward to where we are today, the market's basically saying by the time that material arrives 5 months from now, there's going to be no gap whatsoever. There's no point in doing it. So why not just sit back, keep buying domestic? But I guess, translating that, what that means for the market, I think for the next couple of months, we're probably going to continue to see imports coming in at a fairly rapid clip. We've certainly seen that over the last several months, and that's because the gap was very large between U.S. prices and foreign market. Very, very quickly, though, as we talked about in prior couple of shows, the price of carbon is coming down very rapidly. And I'll give you a snapshot of what the futures are saying, but very quickly we're getting into a situation where those imports aren't all that attractive anymore. And come maybe April, May, June, I think, it's my personal opinion, because this gap is closing up so rapidly, you probably see less traders, less service centers, consumers going out and putting their necks on the line and buying foreign product. It just doesn't make sense to from a cost standpoint.
Hey Nick, on this with European, do you there's a question from the audience. What do you make of the European carbon steel market starting to see price increases from the mills? And is this demand driven or largely increased input costs? Any thoughts there?
Yeah, I guess I don't know for sure whether they're talking about kind of the carbon credit market or carbon steel. I don't follow the carbon credit market all that much, but I do think that market has been on fire quite a bit. Just as they continue to transition toward green energy, making people pay to pollute. I think that market has caught on. Assuming they're talking more about carbon steel, yeah, to the extent
that's true.
To the extent that foreign carbon steel markets are finding support, I think it generally tends to act as a rising tide lifts all boats phenomenon, as does China. It turns into more of a scenario of, well, if European prices are at, let's call it $950, and there's really no reason why domestic prices should ever really dip below that, or maybe even there's an argument why prices should remain at a premium for that type of pricing. Because if European prices are going up, that just means it's going to make it even less attractive to bring in foreign product because it's got such a long lead time. Similarly, if you look at the blue line, we're looking at scrap prices here. So this is busheling scrap. We have seen that market soften a little bit in the last couple of months. And I think that's Let's hope to fuel the fire to the downside on domestic carbon prices in the spot market. But counteracting that, interestingly enough, is the Chinese iron ore market. So you talked a little bit about, some of the price support for European steel. This chart kind of suggests that there might actually be some cost plus support for Chinese prices as well, because 2-3 months ago, price of iron ore was below $90 a metric ton. It's now up about 50% from there. So we're talking about some pretty large increases, and $145 on iron ore is nothing to scoff at. That, all things being equal, does increase the cost of Chinese mills to make finished product. And again, this kind of echoes this idea that if iron ore prices remain supported and Chinese prices remain supported, and European prices are seeing a little bit of price increases from the steel mills, well, then it could actually paint a picture potentially for a softer landing for domestic prices, because I think the rest of the world seeing, even if they're small, price increases, that should lessen the blow. That should provide a little bit of a cushion for where U.S. prices ultimately go. So looking at it today, I know there are some forecasts. There are some analysts out there who are forecasting 800, 700, some calling for sub $700 hot roll for back end of this year. I'll be honest, I don't see the current scenario playing out. A lot of things would have to change in order for that to play out in that way, just given the fact of where foreign markets are, where raw material markets are. It's tough for me to get there unless we go into some full-fledged recession from rate hikes or something like that. And then similarly, I talk about potential cushion for steel prices and steel markets. This is one that we haven't looked at in a little while, but this is the seasonally adjusted automotive sales. This is a U.S. figure, and the market was expecting, so just yesterday or 2 days ago, the market was expecting 13 million units, which would be indicated by basically right in here. Data came out above 15 million units. So I would say domestically within the U.S., the automotive industry is surprised to the upside in a pretty big way. And from what I understand, the automotive industry is working through quite a bit of inventory with regards to metal products. But there is a potential that if automotive, keeps clicking on the way they are and surprising to the upside, and maybe the semiconductor issues get put in the past, Q2, Q3 of this year, there's a potential that automotive could again lessen the blow to the downside of prices. And there are actually even some analysts out there who are calling for kind of a Q2 restock from the automotive industry, which could be centered around this idea that the automotive sector is finally getting caught up with their parts, their raw materials, and that they can actually back up in a normalized production numbers, which I would say is somewhere closer to maybe 16, 17 million units per year range.
Hey, Nick, do you know if these people are taking delivery of these vehicles now, or are they buying for like 6 months from now?
I don't have, I'm not an auto analyst, unfortunately, but I don't have that kind of color. I know that within the big three, and I'm speaking very specifically to myself selfishly, but I've been on a waiting list for the Ford Bronco for a little over a year now, and I just got a notification that that it's going to go into production later this month. So that's anecdotal, but I think that does echo what's happening with a lot of the big three, particularly Ford, because they've got a big wave of EVs that are coming out. And from what I understand, their backlogs are pretty lengthy. A friend of mine actually tried to sign up for the new Bronco just a couple weeks ago, and he was told the lead time is 2 years. So I don't know if that exactly answers your question, but I do think that some of these reservation setups that Tesla kind of introduced, I think they are getting utilized by the big three, and that's helping to create better forecasts, better foresight into what their demand is for the balance of the year.
Yeah, absolutely. Yeah, that's a good, maybe look into the trend, even from an anecdotal standpoint. Yep. Yeah.
And then lastly, looking at the futures, I think the trend is really, yes, we've absolutely seen prices come down at a faster clip than even the market thought 6 months ago. That 6 months ago, we look at the blue line, prices were above $1,800. The expectation was we were going to come down at a very fast rate. Fast forward to where we are today, I would say that the market declined at a faster rate than even what the futures were forecast. You can kind of see that here, that the trajectory has been outpaced by where the futures market is now. But what's interesting as we sit here today on February 3rd, the shape of the futures curve is beginning to flatten out very quickly. Maybe not on the first couple months, because I think there's still an expectation that maybe in the next couple weeks, couple months, we're going to see a continuation of the trend that we've seen for the last 4 to 6 months, which is lower carbon prices across the board. But at some point, there's a belief that we start to hit some sort of trough. We start to hit some sort of fair value price that makes sense, and maybe gets us back to a point that we can actually start looking at fundamentals again of saying, where's the price of scrap? What's the utilization rate? And we can actually start to talk about some of those factors, because for the last year, there really weren't any indicators to look at besides just how long are lead times at the domestic mills and how many price increases they're doing, because it was name your price for the better part of the year. We're very much so not in that realm now within carbon markets, and I think it's much more of a buyer's market for now. But the good news, I don't know, I guess as we look forward, I don't want to pontificate whether it's good news or bad news. There does appear as though there's an expectation that volatility may start to dissipate as we get into Q2, Q3, Q4, and that the range of prices may start to tighten a little bit, which I think would probably be a welcome surprise for not just Ryerson, but for our customers to take out some of that volatility.
Hey, Nick, before you move on from the carbon, we got a question here from the audience. What effect will the falling HR coil market have on plate? So the question about plate, from coil versus plate. So like we talk a lot about, the coil and the sheet, but what kind of impact does that have, falling prices on plate?
It doesn't necessarily have to have any direct impact, because you can make the argument that plate markets are just a different end use market than coil markets. But I would say generally speaking, when you think about just the manufacturing industry, entities and industries that are using coil are probably also using plate. So there tends to be a relationship between the two. The relationship, we've talked about this in prior months, the relationship tends to be carbon sheet prices and coil prices tend to lead plate prices by a couple months. And right now we're seeing plate prices in excess of coated and cold roll market. And I just don't think that phenomenon is going to last too much longer. Again, that's a little bit of my opinion, but generally speaking, on a historical basis, plate has lagged carbon flat roll by a couple months. So if we were to think that relationship holds true, then maybe a lot of these things we're seeing within carbon flat roll, carbon sheet, we start to see it to some degree within the plate market.
And I guess on that, are we still seeing the big price gap between hot rolled and cold rolled?
We are for now. And again, I still fully anticipate that spread to converge, because I've mentioned this in the past, but there is certainly an economic incentive for anybody who has re-rolling capacity to take a coil of hot roll, run it back through a facility, sell it as cold roll, because the spread right now is far in excess of what the cost to do so is. So I would guess that that's very much so on the radar of a lot of the steel mills and re-rollers, and I think for that reason, as we roll through time, we'll see that convert, because there isn't really a fundamental rationale as to why it should be $500, is where the hot roll versus cold roll spread is.